Hi, it's Michael Glennon. Welcome to our quarterly webinar. We're just going to give a bit of an update on the portfolio, the market, how we see it, a couple of stocks, and then talk a little bit about our outlook for the market. And then after that, we'll open up to some questions which you should be able to send through electronically. So I'll just kick off now and just talk a little bit about the market and how we see it. I think it's a pretty unique time at the moment where we sit in terms of, looking at the last 30 years of, equity and debt markets. Overall, taking a bigger sort of picture, you can see in this chart here that we've had, there's been a bit of a flight to quality. We saw that at the end of 12 months ago when a lot of money came out of small and micro cap sector of the market. It impacted us negatively because we were overweight those sectors. And that's continued on, and it's not a bad situation. It's created some opportunities down the bottom end of the portfolio and the bottom end of the market in microcap stocks that are really great businesses that have just been overlooked by the market. So it's a situation that we like. It means we've got a huge amount of opportunities to look at. I keep reiterating that in the monthly NTA reports that we put out for GC1. But this chart here really just shows that the big caps, which is the blue line on the top, has significantly outperformed the small ordinaries index, and part of that's been because you've also had some people shifting from buying bonds which don't have great yields at the moment to looking at bigger companies that are paying higher dividends. So I'm not sure that's the right trade to make, but it is happening, seeing people move out of the bond market where yields aren't really reflecting the risk that's been taken, and they're moving into bigger cap companies. If we have a look at this chart here, just focusing in on small caps, you can see that small resources, where we've traditionally been quite underweight, have significantly underperformed small industrials, and part of that's because, as most people are aware of, trade tension between the US and China has created a bit of uncertainty. However, the Aussie dollar has helped Australian resource companies, but there are cost pressures starting to emerge in small resources. So we've still got a couple of gold stocks in the portfolio which we think should do well with gold prices where they're at now. We think that gold price will stay high while there is a bit of uncertainty around trade conditions. But overall, we are still underweight small resources. In terms of the economy, we're sitting there with low inflation, low unemployment, low interest rates. But what we do have, and where we've tried to position the portfolio a little bit, is there is still strong infrastructure spend in New South Wales and Victoria. It's very hard to get pure play exposure to that infrastructure spend. We'll talk about a stock a bit later on that has got some exposure to that and how we're positioning the portfolio. And we are still seeing, capex in coal, iron ore, oil and gas. In terms of, I think we put this slide up for most of our presentations, but what I really want to point out about this slide with the investment cycle and where you're at, you've had this situation, some of you will be aware, we were quite overweight some of those high growth stocks earlier in the year. For a long period of time, we've held a lot of high growth companies. I'm at the point now where I can't seem to justify their valuation. So if you look at this chart here, you've got all this optimism, excitement and things about companies like Afterpay and WiseTech and things like that. Yet if you have a look at the right-hand side of the chart where you've got a bit of depression and desperation, that's where we were 12 months ago with the microcaps. So there's different parts of the market are experiencing different sentiment towards the outlook for businesses, and we're incredibly concerned about some of these high growth stocks and the valuations. There's nothing there to support these valuations, and while I think Afterpay is a great business, I think the guys have done incredibly well. I can get a valuation of close to $50 on that stock. I can also struggle with how I risk weight it and how you assess legislative risks and things like that. So $50 would be a best case scenario, but we're starting to see volatility in that. I've got no idea about how the government's going to go in terms of regulating that business. It's in the 100 now, so we can't buy it back. But I think you'll see all of these high-tech stocks move down into this stage where they actually start to get sold off a little bit. You've had some big investment banks putting out reports on some of these high-growth businesses saying that they're worth significantly less than where they're trading at. Australian tech stocks are globally the most expensive in the world. So, that's why we've moved out of there, and we've started to fish down the bottom of companies that, you know, people are sort of depressed about. They don't like basic industrial businesses. Some of you are aware we've picked up a position in Hills, which has been on the decline for 6 or 7 years, but we're actually starting to see a little bit of change. We've got some good businesses within Hills. So we are starting to find a huge amount of opportunities. It's just a matter of working our way through them, buying businesses that have got good cash flows and are trading on decent multiples. And if we end up lagging the market a little bit because we've got a portfolio of great businesses that the market hasn't yet started to re-rate, I'm comfortable with that situation. If you just have a look at this slide here, which has got where interest rates have gone over the last sort of 10 years, you can see, we're at very historic lows, and that does create a bit of a dangerous situation in terms of equity market valuations. But where I think those valuations have been stretched, as I said before, is in that tech end of the market. And Australia is incredibly expensive for tech stocks, but you do have people buying other assets as bond proxies, as I mentioned earlier. People are buying big cap stocks because they think the yield's significantly more attractive than what they're getting on their bonds, and it does mean that this situation where you've got some overpriced stocks might perpetuate for some period of time. We'd like to look a little bit longer through that and think that these interest rates won't remain low forever. We are at historic lows, and at some point in time, the impact of low interest rates will flow through to the economy and start to stimulate a little bit of growth. To put it in context, this is what's happened with term deposit rates. So for us, this is just a bit of a proxy for having a yield curve, using bank term deposits for it. And so there's been a lot of talk about inverse yield curves and things like that. It's not actually the case here with term deposits, which is where your average person, there's $500 billion worth of money in Australia in term deposits, but it does mean the outlook is for low rates for a long period of time. And so in the next couple of years, I don't think you'll be getting any pickup in interest rates. But how much more can valuations get stretched? I think they're already stretched as it is. So it's still all pointing towards this case for where we're investing at that bottom end of the market, more in the value segment. So there has been a very clear shift from some growth stocks in the portfolio down to some value positions. So, I always put this slide in. So to reiterate a little bit, if you are investing in Aussie equities, you can either buy big caps or small caps. I've never been a fan of big caps. I think you can't really get much more than GDP growth, whereas, we're trying to find businesses that, can are either undervalued and very cheap and can keep growing and need capital and things like that, or they can make acquisitions and they're small, and each acquisition incrementally adds a significant amount of earnings growth to the business. And just the other side of that is the Australian big cap universe is very, very heavily dominated, as you can see here by the chart on the left, by banks, whereas there's so many small. Actually holding a diversified portfolio of small companies, you can actually have a lot more sector diversification, get exposure to a greater range of industries, as you can see here from how the index is split up. There's a lot more businesses that do a lot more different things than just buying like an ETF that does the top 100. You're really just buying half a portfolio of banks. And if the outlook for banks is not great, that's really what you're exposing yourself to. So just giving a bit of an overview of where we're at, you can see top line in red, that's how small growth stocks have performed, and the bottom line's value. And so value has significantly underperformed growth the last 12 months. But the reassuring thing about that is, as I said, I just think valuations are so stretched in the growth end of the market that it probably is suggesting that the valuation differential between the two is significant. And I think that you'll start to see growth coming backwards and value really starting to narrow that gap in performance, because owning a portfolio of good businesses that are now very, very cheap, the cheapest you've been able to buy some of these businesses in a very long period of time, it's a nice place to be sitting in. So just if I move on to the portfolio, this is contribution to returns for the last quarter. You can see Hills Industries, which I mentioned before, was a big contributor. It has come back somewhat, but I think that's a business that's incredibly cheap. We've written about it in our newsletter before. Collins Foods has done well. Pro Medicus we've sold out of now. Management was selling down stock. I think management there's done an excellent job, but there's no way that business is worth what it's trading at now. Enero has been re-rated, and Noni B we've spoken about before in some of our newsletters. Those guys are getting margin growth. We have lost some money in Nearmap, which was also getting expensive. I think it's a great business, but we can no longer justify the valuations in it. Jumbo and Appen have continued to go up after we've sold those businesses, but we've made a lot of money out of both of those businesses over a long period of time. And this is just the return for the quarter. And Althea has been sold off a little bit due to people a little bit concerned about changes in legislation in the US. If we move forward to have a look at contribution for the year, we haven't. If I just talk about the negative impacts first, I wrote off the position in Access today. I'm incredibly annoyed about it. We were lied to by management. I think it's criminal what happened there. That business is still actually performing all right. It's been sold, just that the equity's been written off through bad management decisions. And honestly, I hope ASIC does something to the directors there. Everyone can go out and have a look in all the ASX announcements. Never once did they mention that they breached their lending covenants, but they would have known what those lending covenants were when they entered into them. And Emeco, we probably had too big a position and it re-rated downwards. So they're the two big things over the 12 months. That is coming up to 12 months ago now where, that value was lost. And if you look at the positive side, Paramedicus, we exited that position, but it did contribute a significant amount to the portfolio, but it's expensive. Same with IDP Education, another business that's expensive that we've exited. Same with Nearmap and Appen. So we have benefited from those growth stocks, but now we've completely shifted out of most of those companies and taken on a bit more of a value bent. And you'll see from the previous slide, where things like Hills, which is a value position we've picked up, starting to contribute to total portfolio performance. So just to talk about a few businesses that are in the portfolio that we like, I mentioned things that were positive in the domestic economy. One of those things is infrastructure spend, and one of the ways to play that is through a company like ServiceStream, which predominantly operates in the telco and also the infrastructure space. So you get a benefit from that infrastructure spend that's occurring. But this is a business that's had 13 quarters of consecutive growth. And it's not huge growth. We've had the business for a couple of years now in the portfolio. The share price has performed very well, but it is a business that's been growing for the last 5 years. As I said, 13 quarters of consecutive growth. It's not overly expensive for a quality company, and it's a nice company to have sitting in the portfolio. These are the investment metrics. You can see that revenue's been growing, albeit quite slowly, but you can also see that profit's been growing considerably. If you have a look at the FY22 number, it doesn't look like there's much growth there. Well, it's actually negligible growth there, but the company has been making acquisitions. And the other thing they don't price into these forecasts is the impact of acquisitions and winning new contracts. They are big contracts that with people like they're doing rollout for NBN, they're doing 5G rollout for Optus. So big contracts, big thematics. We all know that 5G is coming. There's still a lot of people signing up to NBN, so they benefit from that tailwind of growth. They do a little bit of work with Foxtel, which is coming off a little bit, but it's a great business. It's been growing steadily for a long period of time, and it's a nice company to have in the portfolio. I've just got Alan here with me now. Alan's going to talk about Money3, which is one of the larger positions in the portfolio.
Yeah, Money3 is a specialist niche auto loan provider based out of Melbourne. It's been held back a little bit over the last 12 or 18 months because its exposure to its SAC business, which is now effectively exited. It was sold to a current shareholder for $45 million, which was a good outcome. But it was a very profitable business, and it generated in excess of 15 million of EBITDA, which on a base of 60 million is a fair lump of contribution. So there's a flat year this year we're expecting, but as we move forward there, if we look at the numbers, we're expecting EPS to be down a touch this year, and then we're expecting EPS growth of in excess of 20% for fiscal 21, and then just under 15% for 22, and possibly another 15 in 23 going forward. The loan book now is just north of $300 million, $350 million. We expect that can double over the next couple of years. They're currently refinancing that loan book with a bigger finance provider, and that's going to shave 200 basis points off their cost of funds. So that will flow directly to pre-tax line, which we estimate will be somewhere in the vicinity of $4 to $5 million. We expect that to be achieved in the next 12 months. So that will hit the P&L in 21 as well. And it's also made an expansion into New Zealand. It bought a small similar auto loan book there, and that's going very, very well. And we expect that management will be hunting down further acquisitions in the same space going forward. So we like the outlook for Money3. It's got a very good EPS growth profile. It's got a decent yield at 5%. And we think it's cheap on a single-digit PE going forward. So we like the prospects of Money3 going forward.
Okay, thanks for that, Alan. Just in terms of our outlook, as I mentioned, as Alan just said, look, Money3 is on a single-digit PE. There's a huge amount of businesses out there that are on single-digit PEs. The way I think about, buying companies that are on low PEs, maybe a lot of them are not great, but if you buy a business on a PE of 7 or 8 times in 7 or 8 years, simplistically without getting too involved, you'll own that whole business, if you're able to buy the whole thing and use its cash flows to pay it back. Whereas you buy a company that's trading on 100 times and it's got, it's going to take you 100 years to actually own that business. And that's the way I like to think about a business. How long will it take me to actually own this business? And that's why we have been able to invest in tech and high growth stocks before, because if you look just a couple of years out, sometimes they do justify their earnings. I just can't justify the prices of a lot of the tech stuffs now. And you are starting to see a little bit of capitulation from the investors in those stocks. And the other thing that worries me about the changing dynamics of the Australian market, is the rise of the ETF. And the problem with the ETF, it's a self-fulfilling prophecy. So as the stock starts to increase in price, the ETF has to buy more of that business, but it also happens on the downside. So you actually end up with sharp swings on the upside and the downside. And I think it's going to be horrible trying to get out of a lot of these tech stocks when they're all being sold off by index funds, because they have to sell because the price goes down. The more the price goes down, the more they have to sell. So that side of things scares me. Where we're sort of fishing for stocks now, a lot of these stocks aren't in the index, so there's no impact from ETFs. You can't get exposure to these businesses through an ETF, so it's a nice place to be. We're coming up to reporting season. I don't expect too many big surprises on the downgrade side. We've had a couple of businesses like Scarly that have already come out and mentioned that their sales are going to be a little bit weak. Yet other retailers like Kogan haven't announced anything like that, still rolling out new products into new areas. So it'll be, I really think, picking those segments, people who've got exposure to infrastructure and stronger segments of the Australian economy, and it's not all weak and it's not all dire. I think that the portfolio will do well. We'll be busy getting out to a lot of those AGMs, and a reminder that our AGM, I think, is on the 8th of November, so you're all welcome to attend that. That's here in Sydney. The other thing I think has been a little bit overplayed in the Aussie market is Australian companies that are growing internationally. People are concerned about domestic growth, but a lot of those businesses are very expensive. So for us, one of the key things we're looking out for in some of these smaller businesses is, do they have any exposure to being able to go into the US or Europe and get some growth there? And as I already mentioned a few times, infrastructure spending, we're getting exposure there through companies like ServiceStream. All right, so if anyone's got any questions, I think you can do them through your computer and we'll answer them. We've already had one, and someone mentioned about the buyback, and it's reducing the size of the business, and has it had any impact? And why do we still persist? To answer that question, yeah, look, I mean, there's a couple of arguments with the buyback. Yes, it does make the business smaller, but it's incredibly accretive while we trade at a discount. So yeah, we've been buying back stock. Not No, there's been more sellers coming out, but there's been just a general shift in the Australian market a little bit away from small caps. So I actually think it's probably the time to be buying it. You had a big sell-off 12 months ago. They haven't really performed significantly this year. So I think now, I like buying things a bit out of favour. I'd be buying small caps now, and we're reasonably optimistic about small caps. I wasn't saying that 12 months ago. So yeah, the buyback, look, I think it has pushed the price up a little bit. We're trading only at about a 10% discount to NTA. That's actually pretty narrow when you have a look at the universe of LICs out there. I think over time, as the LIC performs and we get the NTA back over $1, I don't think we'll have a problem, growing the business. And as I said, I'm very optimistic about, the landscape for small caps now. So yeah, the buyback's mopping up a bit of demand for people that want to get out, but it is accretive to portfolio performance. And if you can, buy shares at 86 cents when they've got, 97 cents or so of NTA in it, it's not a bad position to be in. So if we got any more questions, you can type them into your screen. Oh, here we go. All right, so a couple of questions have just come in. So someone's asked about what are we doing to close the gap between our share price and the NTA? So, and what percentage of the portfolio is in cash? So the cash is the highest we've ever had it. As I said, look, I selectively exited out of the high PE stocks. The cash is close to 50% in the portfolio. I'm not unhappy about that because I'm incredibly concerned about the downside risk of where we had the portfolio invested, and it gives us a nice pool of cash to be able to go out and buy some of these value situations as we find them. I'm not in a rush to go out and buy them. And in terms of the discount to NTA, look, it is low. It's a lot narrower than where a lot of other LICs are trading at. So it is about 10%. So that actually puts us in the sort of top quartile of discounts to NTAs. We won't trade at a premium. I think even some of Jeff Wilson's funds are trading at a discount now, and they've traded at a premium for years. It's just a characteristic of the market at the moment. Someone else, the next question is, the market appeared to have a mini panic attack after the director sale in ServiceStream yesterday. Any thoughts on the sale or director selling in general? Yeah, look, my general thoughts on director selling is that it's bad. I mean, though it's not always bad. If you take the case of Sam Hupert from Pro Medicus, that's a guy who actually ran into skiing about 4 or 5 years ago, and I don't think he's spent a cent on himself ever. He's been involved in that business. I think JB Weir listed Pro Medicus in 2002, and he's never sold a single share. Let me just get rid of that. He's never sold a single share, and so even he's looking at a company like Pro Medicus and saying, well, it's overvalued here, I'll take some money off the table. Generally, it's a bad sign. We've exited many positions when CEOs have sold. But look, no, I don't think it's a massive issue in ServiceStream. One of the issues in ServiceStream is you don't have any big owner operator in the business. The largest shareholder's got 5% in the business. So you don't have an owner operator in ServiceStream. It's more of an issue where you've got a big shareholder who's got 40, 50%, the same as which is why I mentioned the guys from Pro Medicus. They have big shareholdings and they're taking a lot of stock off the table. Less of an issue in this case. Okay. All right, that appears, if anyone's got a question, send them through now. Oh yeah, so are there any marketing initiatives we're going to embark on to help the share price? Yes, look, I did pull back from the marketing, to be honest with you. At the beginning of the year, I wanted to focus on the portfolio. It does take a big effort, but we've recommenced doing our newsletter, as most of you be aware. If you're not getting our newsletter, go to our website. You can subscribe to it there. We put it out every week. The odd week we might miss when we're traveling and we just don't get around to doing it. We'll be recommencing. We do an institutional sort of roadshow to brokers and things like that. So we'll be recommencing that, but I did want to settle down and focus on it. I resigned off the board of Glennon Capital a month or so ago to I really felt I was a bit overwhelmed with stuff. I don't really just want to, there's so many opportunities now that Alan and I are getting out there seeing a lot of stocks, and that's where I just want to focus my time going forward. So getting back to core things, and as I said, there's so many opportunities. We've probably got a list of 40 or 50 companies that we want to go and see and do work on. So that's where we're at. Yeah, and look, we will let you know about the marketing and what we're doing, but as I said, we've kicked off the newsletters started again, and we're back doing the webinars. So there'll be another one. I think the next one's in February. You can have a look on the GoToWebinar website where this is through, and the next one's already scheduled. So we'll be doing that. All right, now we've got a few more questions. So what key features filtering when selecting a value stock? Do you want to answer that, Al?
Yeah.
All right.
When we're looking at the value stocks, we're looking at a couple of key metrics. We're looking at, first of all, the ability of the business to grow organically. So we're looking at the top line, the revenue growth, and then we're looking to see how much of that can feed through to earnings. So we're looking at the margin. So we're looking at EBITDA growth, and then that as it flows through to EPS growth. And then we obviously want to check about what price we have to pay for that EPS growth. So we're thinking if we can find stocks that are growing faster than the PE would suggest, well, then we've got a half a chance of making a decent return out of our money. So they're the main filters that we look at: revenue growth, ability to turn revenue into earnings into cash, and it's priced at a multiple that doesn't require especially dramatic growth rates to achieve it.
All right, so here's a question on what a stock we held a few years ago. What are our thoughts on Retail Food Group? Yeah, the analyst that bought Retail Food Group here, and I had a very big argument about it. And it wasn't a big position in the portfolio for very long. It might have only been a couple of weeks because I felt incredibly uncomfortable with it. And as I said to the analyst at the time, if I took your salary and put the whole lot of it for the next 12 months into Retail Food Group, would you still be as confident? He said yes. Well, that was at $6, and I think we sold out at about $6. We didn't make or lose money. Actually, we might have made a small money out of Retail Food Group, but no, I don't like the business. I've never liked the business, and it should never become part of the portfolio. And I guess it's just one of those things with analysts and giving them a bit of discretion. Alan and I've worked together before at Paradise back when I had more hair and was better looking and all that sort of stuff. So, but Alan's a very fundamental analyst. I like the way Alan works and thinks about stocks. So I don't think he'd be buying a business like Retail Food Group, and I wouldn't put anyone's money into a business like that. Yeah, and we didn't participate in the recapitalisation either. We just decided it wasn't a good business, and we didn't want to be there at any price. Yep. So the next question is, what did we learn from the last 12 months and what did we change? I think we've already, the mistakes we made over the last 12 months, we were overweight microcaps. Alan and I talk about our weighting in microcaps. Now every day it's about 15% of the portfolio at this point in time. It was up at about 30 or 40%. It was bad portfolio construction. We spent most of January and February rejigging our systems here. I came out and said I think it was the commentary for the full year results, might have been the half year results, probably the best risk management system I've ever had here. Bloomberg sits behind it, gives us a lot of analysis in terms of sectoral weightings, market cap biases and things like that. So, and the other thing was, we probably had too great a individual stock exposure in cyclical stocks. So that's what explains the Emeco position. There was nothing fundamentally wrong with the business, but it's a cyclical business. You don't want to have your biggest position in a cyclical business where the market can change its valuation of those companies very, very quickly. You can make a lot of money out of them, but you can also, as we experienced, lose a significant amount of money. But it wasn't like 20% of the portfolio. It was a 10% position. It was well within our risk parameters. It was just too much for a cyclical stock. So I guess the lessons from the last 12 months, our portfolio construction's gotten a lot better. It's been supplemented with systems and infrastructure that we've put in place. We've changed some people in the investment team. We've brought some other people on. You know, I've reduced my time doing sort of different types of things. We've brought on someone internally that looks after all the accounting here and reconciling NTAs and things like that with the back office. You know, and I've resigned off the board of Excelsior. And as some of you will know, you know, I went on the board of BHD, which has taken some time, but about 25% of our client base in terms of financial planners has exposure to BHD. So if you are one of those people, you know, you're getting, hopefully we get a resolution on that very soon. We don't do it to make money, but it's here to help our clients out, and hopefully in the long run they'll continue backing us. Next question says, with the opportunities we're seeing, are we likely to use up the cash? Yep, we'll use all the cash. I try not to make strategic decisions about cash and whether we should go to cash or not, but I made a decision that the high PE stocks that we had were all that had a big run for the last couple of months, and I just can't sleep at night with the valuations on them. And I still really like businesses like Afterpay, which you all know have done very well out over the last few years. But I just can't justify this price on it, because when I risk weight that $50 valuation, I get back to about the current share price, and I just don't have enough ability to assess the risks of, you know, new entrants coming in, or someone like a Android Pay or Google Pay or Apple Pay just putting a pay later button. They've got very, very big balance sheets, those businesses, and that could be a serious risk to a company like Afterpay. So you need to bring your valuation back down for something like that. Next question is, well, someone just said, what's changed internally? I think it's internally, or it might be internationally, but anyway, internally in the last 12 months. Well, I think I've already sort of answered that. You know, I brought Alan on. Alan and I have worked together for, you know, known each other for a very long period of time. As I said, we worked together in 2002 at Paradise. We've been in contact since then. You know, Alan's had his own firm. Alan, you know, was quite influential in my way of thinking about stocks early on. He's very fundamental. You know, a lot of our process was built around stuff that I did that I thought worked well when I was at Paradise, and I've evolved a little bit. You know, Alan was at Paradise and gone off and evolved some of his stuff as well. So, you know, the philosophy and the basis that we're looking at stocks is very, very similar. We complement to each other, which is why I brought him on. And the other thing internally, I guess we've got a significantly the best risk management system I've ever had. Doesn't mean it's the best out there, but the best one I've ever had. And we've brought on someone internally that does accounting. Oh yeah, and we've brought on a new junior analyst, Kenny Tam, who's excellent, does a lot of background work on modelling for us, organising company visits. Very strong addition to the team. So yeah, there's been a lot of changes. I'm pretty comfortable with where we sit now in terms of resources and things like that. I'm comfortable with the outlook for the market, and I'm comfortable there's a heap of cheap value stocks out there that I can go and pick up. Yeah. So yeah, someone's asking if we measure the beta on the portfolio. No, I don't. I'm loosely aware of it. Someone asked me a couple of years ago if I measure some other stat. Really, we're just buying businesses. I'm not trying to construct a portfolio that's got a beta above or below the market. If I had to have a guess now, I'd say the beta of the portfolio is below the market, because we have taken that value bent in the portfolio. That also means, because there's a low valuation level in the portfolio, that if the market does turn down, given the cash, you know, and we don't have any high PE stocks in the portfolio should outperform the market. And I'm very much focused on, you know, absolute level of NTA, so growing the NTA. So that puts the portfolio in a good position. The market goes down, we shouldn't go down anywhere near as much as the market. We've got cash. We can, if the market does go down a lot, you know, we can pick up some stocks selectively as they get re-rated. Any update on McMahon and Libby? Yeah, look, Levis is expensive now. It's a great business. I don't think it's a business you want to have your entire life savings in forever. It's cheap women's jewelry, and they'll get caught in the wrong side of fashion, or, you know, we don't really know what the experience in the US is. We don't own it anymore. We don't really know what the experience in the US is going to be in terms of costs of rollout stores and profitability. And McMahon, you know, Alan and I had them in the other day. The problem with McMahon is they probably need to pay a bigger dividend, but if they pay a bigger dividend, well, they probably won't pay a bigger dividend because they're always optimistic they're going to get more work. If they get more work, they need more working capital, so you can't pay the money out as a dividend. So yeah, you got to remember these businesses, and from the mistake we made in Emeco, they're mining services businesses, and you don't want to have a huge exposure to them in their portfolio. And we did very well out of McMahon. We bought it at, right at the bottom. We wrote it for a turnaround. We're keeping an eye on it. There is some upside if they get those profit share payments coming out of Indonesia, but there are other risks in the portfolio. So, and I also think management's lost a little bit of credibility. Every 6 months they come out with a new sort of surprise to the market that just the market wasn't expecting. So that does make the business worth a little bit less in terms of valuation, because there's always that potential that you're going to get a negative surprise, and they're not positive surprises that they're coming out with. Well, okay. So why are we seeing opportunities now when we didn't see them a couple of months ago? Oh, we've been seeing opportunities all year. Since that sell-off in 12 months ago, from October really through to the early January, that started to create a lot of opportunities, and it just takes time to go through those investments. You really need to get out there and meet management and see, and so it takes time to get through all those. I don't think we need to rush. It's not one of those things where if we need to go and buy them all at once, we'll make a mistake if we do that. So it's getting out there, seeing the businesses, doing some work on them, thinking about where they're right for the portfolio, and adding them to the portfolio. Where are we at now? Yeah, I'm not sure that's the question. Anyway, what are the top 5 stocks at the moment, please? Well, they're the same as we put out in our monthly NTA, which is why I didn't put them in the presentation. But the largest position is Money 3 that Alan spoke about earlier, and the rest are as per the NTA announcement. I don't want to go into anything now that's not on that announcement. But yeah, because I'm always a bit cautious about what we put out there in terms of stocks and what's not in the market. So we have changed things around a little bit last couple of days. Yep. Well, that appears to be all of the questions. Thanks everyone for listening. We will have another one in February. If you don't get our newsletter, please go to the website and subscribe to the newsletter, and you get that every Saturday morning. And thanks for attending.